came along. I into the sound of your voice. I like it. Yo, let us stay alive. Feels alright, right. Every time we're together, let it flow. Let us stay alive. Feels alright, right. Oh, every time we're together, we're riding through the city. We go. Take me in your arms and take me to the red zone. Take me to the moon and spark a light. And everything is looking and it's feeling like the perfect night. And that's the sound I like. And take me for a ride, just feel a little lighter. Everything is sitting on everything. Take me in your arms and take me to the red zone and take me to the moon and spark a light. And everything is looking and it's feeling like the perfect night. And that's the sound I like. And take me for a ride, just feel a little lighter. Everything is sitting on a slick margarita and it's all.
All right, thank you all for tuning in to WGHC 98.3 FM, your voice and music, your station. My name is Jeff Badu, and I'm a serial entrepreneur and a wealth multiplier. I'm the founder and CEO of Badu Enterprises, which is a multinational conglomerate in the finance industry. So today we'll continue the discussion. Last week we talked about tax tips for business owners. Today we'll be transitioning to real estate investors. So we'll be talking similar things, but instead we'll get deeper into the real estate conversation. Talk about some of the more lucrative tax strategies out there to avoid paying or to avoid overpaying in taxes. Before we do that, let's kick it off with the market report. This report is as of November 1st, 2019. A better than expected jobs report and stronger third quarter earnings from some major companies drove stock prices higher for the fourth consecutive week. The S&P 500 and the NASDAQ reached closing highs, while the other benchmarks indexes essentially posted solid returns. The small caps of the Russell 2000 recorded the largest weekly gain, followed by the NASDAQ, the S&P 500, the Dow Jones, and the Global Dow. Long-term bond prices rose, pulling yields lower as the yield on 10-year treasuries fell 8 basis points. Oil prices went down $56.65 per barrel to $56.14 per barrel. And then the price of COMEX gold went up from $15.0710 per ounce to $15.1570 per ounce. Now get this. So far this year in the stock market, the Dow Jones is up 17.23%. NASDAQ is up 26.39%. S&P 500 is up 22.34%. Russell 2000 is up 17.85%. Global Dow up 13.63%. And then the federal funds target rate is essentially at 1.5. So interest rates did go down last week. Very important. Last Wednesday, interest rates actually went down. So now we're down by 75 basis points for the year. And so now we're at 1.5 to 1.75%. At the beginning of this year, we start off at 2.25 to 2.5%. So we're down almost 1 full percent when it comes to, or 100 basis points when it comes to interest rates or federal funds target rate. What this means is that it allows us the opportunity to borrow more at a lower cost. So interest rates are lower, meaning it's cheaper to borrow money. So if you're an investor, especially one who is in real estate, I mean, it should be heaven right now because interest rates are going down, which pushes all interest rates essentially down. Home rate, student loan rate, car rate. I mean, everything is essentially down when it comes to interest rates. And the stock market is up. So I think we'll finish off the year tremendously. I believe this will be the best year in stock market history, or since essentially 2009. I think that we're in for a very great 2019 and 2020. I have nothing but high hopes for. I think we'll have a fabulous year. Stay strong, stay in the market. Don't get out, don't pull out, without any sort of sensible approach. So that's my advice to everyone. So First and foremost, I'd like to welcome everyone to WGAT 98.3 FM, your voice and music, your station. This is Money Talks, where all we talk is money. If you would like to contribute, or if you would like to ask any questions, comments, anything of that nature, we're streaming live on Facebook at Jeff Badu. You can find me live on Facebook. We're streaming live on Facebook right now. Or you can call into the studio line 773-942-7167. 773-942-7167. That is the studio line. So today, let's just talk some real estate strategies when it comes to taxes and also asset protection. Last time we chatted, we talked about the different types of entities. So I won't get too much into that. But just as a recap, there is the LLC or limited liability company. There's the S corporation, and then there's the C corporation. Those are really your three entity choices when it comes to asset protection. So why you should put your real estate in an entity? Every single piece of property you own or every single piece of real estate you buy for investment should be in some sort of entity, LLC, corporation. Highly recommended LLC. But let's talk about it. The reason why we put real estate in an LLC is because it enhances your credibility. It also protects your personal assets. So if somebody sues you, they can only tap into the assets of the corporation or the LLC as opposed to your personal assets. And with the credibility, basically anytime you have the words LLC, INC, CRP, people just take you a little more serious. Last but not least, it's easier to access capital. So when you're applying for bank financing, you're applying for commercial or even residential loans, it looks better, and it's just better when you have a company because some expenses can be treated as business expenses, for example, for loan purposes, which can improve your debt-to-income ratio. Now, what are the true benefits of an LLC? With an LLC, when you own real estate, you get to avoid what's known as built-in gains taxes. So when you have a corporation and you sell that corporation or you decide to transfer it or anything of that nature, anytime that happens, you trigger what's known as a potential built-in capital gains tax. So we don't want that to happen, especially if we haven't sold the real estate. Another thing about the LLC, there's no FICA tax. So you don't have to pay any self-employment taxes or anything of that nature. So just something to keep in mind. FICA is about 15%. It's easy and low maintenance. Maybe $75 or so to renew every year in the state of Illinois. And then let's talk about the Series LLC. So with a Series LLC, it's an LLC of basically it's one parent LLC that owns multiple LLCs. Now, the beauty of it is you can have one big LLC that owns several LLCs. You buy a property, you put it into one of the sub-LLCs called the cells of the series. They're basically babies to the mother. It's nice, convenient. You file one tax return for the series, separate bank accounts, separate EIN numbers or tax ID numbers. Everything is separate. So it's beautiful when it comes to state law. However, the issue with series LLCs is that they are not recognized or accepted by federal law. So essentially with the Series LLC in the state of Illinois, if somebody sued your Series LLC or they sued one of the cells, they can only claim the assets of one of the cells. However, if they take this case to the Supreme Court or to the federal courts, they could subject all of your cells, towards that liability because Series LLCs aren't technically recognized on a federal basis. It's pretty new, so it's not something that's fully recommended for buy and hold real estate. My attorney essentially says stay away from Series LLCs for now. Maybe down the road, 3 years, 5 years from now, it might be accepted on a federal basis. And for me, I take asset protection very seriously. So if it costs me a few extra $100 or whatever it takes, I am going to do that. I'm going to form the separate LLCs, have each property, owned and controlled by the LLCs. And we'll talk about how to add an extra layer of protection in a second. But separate LLCs for each and every single one of your properties. You should never own an investment property or maintain an investment property in your personal name, even if it's residential. Now, you're probably wondering, how in the world can you do that? Well, you can do what's known as a transfer or quick claim deed. So let's say you bought a property and conventional or FHA is residential. You bought it in your personal name, and then you found out that, hey, you can actually transfer this to a business. What you can do is what's called a quit claim deed. A quit claim deed allows you to transfer or to add beneficial ownership of a property to another party, such as your own company or trust. So let's say you have an LLC. What you can do is, and you own a property in your personal name, say it's a 4-unit, you live in one of the units, and you rent out the other 3 units. You don't want the tenants to know that you own the building, or whatever it is. You start ABC LLC, you do a quick claim deed that adds the LLC to the title of the property. What this allows you to do is it allows you to establish real estate contracts, so such as lease agreements in the name of the LLC. You can have an LLC bank account. Everything can go through the LLC. That way, if the tenant sues you, they can only sue the LLC and not you personally, because everything was done in the name of the LLC. One thing that's important to note is that you must do things. If you form an LLC and you plan for it to manage and operate your real estate, you have to do everything in the name of the LLC. You accept checks in the name of the LLC. You pay bills in the name of the LLC. You do everything in the name of the LLC. You do not do anything outside of the name of the LLC. So that's something very important that you should always keep in mind, is do things in the name of the LLC, or you will get hit with what's known as piercing the corporate veil, which means that you're commingling personal business funds, you undercapitalize the business, and you're basically making it appear as if you're doing things in your personal name, even though you have an LLC that backs you up. So you can have an LLC that's perfectly set up, but if everything is going into your personal name, then the judge will more than likely go against the whole corporate veil or the corporate protection. So just something to keep in mind there. So Series LLC is good, but it's not the best just because it's not recognized on a federal level. And if you want to do a quick claim deed, if you want to do a FHA, you can buy a property as little as 3.5% down payment. Some loans even go as little as 0%. So something you want to consider, but always consider the asset protection. Consult with your attorney, consult with your lender, make sure these things are okay. But ultimately, in a perfect world, this is all how you would want to do it. Now, let's talk about a land trust. So the LLC is great. If somebody sues the LLC, they can only get what's in the LLC. Keyword. So they can still get the building. So if they sue you and if they sue the LLC and the LLC owns the building, they can still get the building. How do you avoid this from happening? You simply set up a land trust at closing, or you set up the land trust before closing. You close in the name of the land trust. What a land trust allows you to do is it adds an extra layer of protection. It adds inside protection of the LLC, meaning that whatever's inside the LLC is protected now. So, the reason for that is because you cannot sue a land trust. You cannot attach a judgment to a land trust in states such as the state of Illinois. So it's ideal to own real estate. You own it by the land trust. You own the real estate by the land trust. And by the way, I'm not an attorney, so anything I say on this radio is not legal advice. These are just simple best practices that I've learned over time. But you own the real estate by the land trust, and you make the LLC the beneficiary of the land trust. This adds that extra layer of protection, which means that if somebody sues your LLC, they cannot get the property. They wasted all that time, all that money, because you had a land trust that cannot be sued, and then you had an LLC that was receiving the beneficial ownership of the trust. So just something to keep in mind is that you cannot, in the state of Illinois, you cannot attach a judgment to a land trust. So this creates both inside and outside protection. Very important. So ideally, in your real estate structure, you'd have your properties owned by a land trust, and then you have the LLC. Each property would be owned by a land trust, and then you'd have either one LLC or multiple LLCs that are beneficial owners of the land trust. Very important that you establish your structure in that way. Always consult with an attorney. An attorney will tell you this. A good attorney at least will tell you these things. If you want maximum OJ Simpson asset protection, then you got to have a land trust. You got to have an LLC. Don't do anything in your personal name. Do not accept any checks in your personal name. Don't pay any bills in your personal name. Don't write any contracts in your personal name. Everything should be done in the name of the trust and in the name of the LLC. Another thing with land trust, it establishes privacy, meaning that if somebody looks up who the owner of the property is, it would say 123 Main Street, or Chicago Trust, Chicago Title Land Trust, 1 2 3 4 5 6 7 8 9. Nobody would know who owns it. Nobody would know you own it. Nobody would even know your LLC owns it. So if you want maximum asset protection and privacy, you would form a land trust to own the property and then have the LLC as the beneficiary of the land trust. That creates maximum asset protection. If you want to take it a step further, you form a Nevada or Wyoming LLC, which is fine. You still have to register it in the state of Illinois and all that good stuff. But you got the land trust that's protecting the asset itself, and then you have the LLC protecting your, whatever you have personally so that nobody sues you personally. So hopefully that was clear. That made sense. That's more on the legal side when it comes to real estate. There's a lot more things in depth when it comes to legal. Consult with your attorney, consult with your lenders, consult with your agents, consult with whoever. But when it comes to asset protection, this is how you should be structuring it. Now let's talk about the taxes, which I'm sure that's what we all came here for. I just spent about 15 minutes or so talking about the taxes. As a business owner, or as someone who owns a business, you can write off a lot. A write-off is simply an offset to your gross income. So with a tax deduction, when you have a real estate property, rental real estate, it goes on what's called the Schedule E of your tax return. So income, expenses of the property goes on the Schedule E. If you're in flips, you're in wholesale, then it could go on the Schedule C for the flips, or it could go on the Schedule D for the flips. Now, you can write off virtually every expense tied to the building. Basically everything. You spent money on a water bill, you paid mortgage interest, property taxes, you did some repairs. Everything is a tax write-off. So if you made $10,000 on a building, you spent $1,000 on a water bill, $2,000 in mortgage interest, $3,000 in property taxes. All those things combined can be written off to minimize your tax liability or reduce your tax liability. These things include mortgage interest, property taxes, repairs, certain types at least. We'll talk about that in a second. Maintenance, utilities, mileage. You traveling to the property, that's a visit to the property. You should be writing that off, even if you live in that property and you're renting it out because you're visiting your rental property. Travel, if you're traveling for business, or if you're traveling, you set up an LLC and you're having board meetings. These are all things you should be taking advantage of. And then the infamous depreciation. Let's talk about depreciation more in depth. Depreciation is simply let's say you bought a building for $100,000. You simply take $100,000 divided by 27.5 and take a deduction for whatever that amount is each and every year for 27 and a half years for residential property. Now, if you're in commercial property, it's 39 years. Now, you might be like, wait a minute, 27 and a half years. It's going to save you on taxes. Over 90% of my clients who are real estate investors don't pay any real estate taxes or no income taxes on their real estate because of depreciation. You might be like, 27 and a half years. I don't have time for that. Let's do accelerated depreciation. Well, thanks to the new, Tax Reform, Tax Cuts and Jobs Act, there has been new depreciation rules which allows you to accelerate certain components of the building, such as the roof, flooring, appliances, stuff that you've attached to the property. You're now allowed to write those things off fully upfront in the first year. So if you put a new roof on a house, you could potentially fully write it off. If you bought new appliances, instead of 27 and a half years, we do it over 1 year. and fully expense it in the first year. So new what's called Section 179 rules that allows you to deduct certain additions or improvements to the property in full. Even if you bought this property rehab, you can do what's called a cost segregation study. You don't have to. You can do your own study if you know how much the roof costs. I highly recommend, if you want to do this strategy, you got to make sure you itemize. You have to make sure you know how much the roof costs. You have to make sure you know how much the appliances cost. How much the flooring costs, the hardwood, the tiles, everything. Those things you have to know how much they cost, because you can write those things off up front in the year you bought the property instead of waiting 27 and a half years. And here's the good thing about banks. I used to not like banks, but now I actually love banks, because what they can do is they can add that back. Since you're depreciating these things, they know it's not a real cost. They can add this number back, whatever that number comes out to depreciation. Let's say you depreciated $20,000 worth of, flooring, and now your taxable income is reduced by $20,000. What the bank will do is they'll add that $20,000 back to your income in order to calculate your debt to income ratio. That's very powerful. You're minimizing your tax liability, and the bank is still counting that towards, counting that taxable income towards your income. That's very powerful. So depreciation, the more things you can depreciate, the better, because it can truly impact your financing status to the banks. And if you're in real estate, you know for sure that the banks are very important to make sure that you look good on paper when it comes to financing, even if you're minimizing your tax liability. So when you do all these depreciation and accelerate it, we can, of course, anything you don't understand, let's schedule a follow-up. You can accelerate the depreciation, helps reduce your taxable income, and it can also not impact your ability to be financeable, essentially. Let's talk about some tax strategies. Let's talk about some more advanced stuff that you might have never heard of in your life before. You bought the real estate, nice piece of property. It's building you wealth. It could be passed down from generation to generation. You're building equity over time as a tenant is paying this mortgage. You're gaining tax benefits from it. You're getting to depreciate things over time, repairs, improvements. Now you might be like, okay, well, I'm ready to sell this piece of property. How do I sell it? Well, I have good news for you. You can sell the property tax-free. You can escape taxes 100% when it comes to real estate. Income taxes, at least. Not property taxes, but income taxes. So there's what's called the homeowner's exclusion. And by the way, there is a way to escape property taxes, but that's a whole nother segment. Homeowner's exclusion is the ability to... This applies mainly for your primary residence. Essentially, if you bought a property, let's say for $100,000, right? 2 years later, that property somehow appreciated to $150,000. You can sell that building as long as you lived in that building or you claim it as your primary residence. If you lived in that 2-year period and did nothing else, you can sell that building tax-free and make a $50,000 tax-free profit. That's what's called the homeowner's exclusion. Up to $250,000 of the gain is not taxable if you lived in the house for 2 out of the past 5. Or they make it sound so complicated, but all you have to do is live in the property 2 years before you filed your taxes, basically. As long as you did that and you sold it, you can sell it tax-free. Up to $250,000 if you're single. And guess what? Here's why I recommend people get married. If you're married, it's $500,000 tax-free. So if you bought a house, let's say this home you've been living in, you bought it for $100,000, it went up to $600,000 in value, and you're married, guess what? You get to sell it 100% tax-free. $500,000 cash that the IRS never sees a piece of. That's very powerful. Very, very powerful. So that's one strategy if you want to sell the real estate tax-free. It has to be a primary residence, at least the last 2 years. Now, another one is 1031 exchange, which is simply you trading one rental property for another. This only applies to rentals or properties that you hold for a long period of time. You essentially take a property that you bought and you're ready to sell. You sell it, and then you go out and buy another property. You're basically trading one property for another. The beauty of this is instead of paying capital gains taxes, knowing that you're going to buy another one, all you got to do, it does cost money, of course. You take that building, you can buy one more. You can trade it for one, you can trade it for two, trade it for three, trade it for 10, trade it for 100, tax-free. So it basically saying, okay, the IRS encourages, or the government encourages people to buy real estate. So if we know this person is in it for the long run anyway, why not give them a tax incentive and avoid them from paying capital gains taxes? So that's what's called the 1031 exchange. It's pretty complicated, a lot of details in it, but for simplicity's purposes, you're just trading one rental property for another. It can be residential, commercial, land, mixed use, whatever. Realty for realty. Real estate for real estate. That's all you got to do. You can't trade a building for a car. You can't trade it has to be building or real asset. So a real something you can touch and hold for another real or real estate asset. Now let's talk about opportunity zones, the hottest topic since the cannabis industry came up. Opportunity zones are the ability to flip, so not just rentals, but flip and rent properties in traditionally underserved neighborhoods, such as Inglewood on the south side of Chicago. So you're buying properties in neighborhoods that are not, they haven't been up to par, or they're not like your typical suburbs or anything. They're your quote-unquote rough neighborhoods. So you buy a property, so you can take whatever gains you've made, and let's say you bought stocks. You bought and sold some stocks. You bought and sold some real estate, and you're ready to take some gains and reinvest it into one of these opportunity zones. It can be a building you bought, or it can be into a fund that somebody else has. The nice thing is, if you take that profit or whatever amount you decide to take and reinvest it into one of these opportunity zone properties, and you improve the building, you have to significantly, quote unquote, improve the building. You don't have to pay any taxes on that capital gain, because remember, the IRS is encouraging you to invest, especially invest in something that really, really needs to be invested into, traditionally underserved neighborhoods. So this is an awesome way to revitalize communities. This is not gentrification or anything like that. This is simply improving neighborhoods, which I'm personally a part of. Gary, Indiana, Inglewood, Woodlawn, all these neighborhoods. I'm a part of the revamp, essentially. So the IRS or the cities have identified opportunity zones that allows you to invest into the opportunity zone and essentially gain a tax write-off for that. So that's something to keep in mind, and I'm sorry, not a tax write-off, but the ability to not pay taxes on the gains that you've made from the money that you put into these zones. So you bought a building, you bought a building for $100, you sold it for $150, you bought it cash, now you have $150,000 cash. You put it into a project, or even just the $50,000 gain, you put it into a project, no taxes. You get to defer it up to about 10 years or so. And if you cross the 10-year mark, around that, you get to essentially not pay any taxes. So you can sell that last building, or that building that you put the money into, you can sell it, zero taxes on that initial. Of course, there's other deductions you can have. So basically, it allows you to sell a building tax-free by holding it for a long time if you invest in an opportunity zone. Last but not least, let's talk about charitable remainder trusts. Like, wow, these are awesome strategies. I love homeowners exclusion, love 1031, love opportunity zones, but what else is out there? The last one is a charitable remainder trust, or charitable LLC. Very complicated, highly complicated. Basically, this is what you're doing. You're taking a building, you bought it for $100, and it's appreciated to $500,000. You're like, you don't want to pay taxes on $400,000 of income. You just don't want to do that. And you don't want to sell. I mean, you do want to sell, but you don't want to go through the complications of 1031 and all of this. You're just looking to get out of real estate. but you don't want to incur unnecessary taxes. So what you can do is you can form an LLC, right? Or let's say the building is an LLC. Ideally, you form a new LLC. You transfer the title from that one LLC to the new LLC or whatever the building was in. So that building that is worth $600,000. Or I'm sorry, you bought it for $100. Now it's at $500. That's a $400,000 capital gain. So you form the LLC, you transfer. There's no tax there because you're transferring from yourself to yourself, basically. You're the 100% owner and manager of the LLC. What you do is you identify a charity of choice. It can be your friends, whoever's charity, except for yours. You find a charity, and what you do is you gift 99% of, or up to 99% of the beneficial ownership of the LLC to the charity. What you've done, you've created a charitable deduction. You've created a tax write-off up to 90% of whatever you donated. So let's just say that $300,000 write-off. That's a $300,000 tax deduction in the first year alone, 1 year. Right. So you donate it. Now all the money, that's all the income and expenses. Let's say you decide to keep the building, or even if you sell it, well, basically you don't have to pay any capital gains tax except for 1% of the income, because you just gifted 99% of the ownership to a charity that doesn't pay any taxes. So you've created a tax write-off. Now let's say you decided to keep the building. Any income that's made is going to go 1% to you as far as tax write-off, 99% to the charity as far as taxable on paper income. Here's the key. You still have 100% control of that property because you're the managing member of the LLC. You can take out a loan on the building or whatever money's in the LLC and do a 2% interest rate and say, I'm going to pay this back every year. You can set whatever terms you want, basically, on a loan. To protect yourself, we usually add life insurance in order to protect the equity that's in the building or the equity that's due to the charity. Because you promised them 99% of whatever it is was in there at the time. So we usually wrap life insurance around it in order to pay back. So at the event of death. And by the way, this can be passed down 3 generations. So if you hold the building, you can keep passing that charitable LLC, that 1% you own, you can just keep passing it. And then when that 3rd generation dies, then that's where the tax bill, or that's where the money is due to the charity. But by that time, you would have built so much wealth. Basically what you're doing is you're building tax-free wealth at this stage. It can get way more complicated, but the charitable LLC allows you to gift a property or whatever it is, something that's been appreciated, to a charity. You get the write-off, and you still maintain ownership or beneficial ownership of the of that LLC or trust. Very powerful way. Usually it's for the high net worth, ultra high net worth. Of course, it costs money. You need an attorney. You need an accountant. You need a lot of different people involved. But very powerful way to not have to go through the 1031s and the opportunity zones. This is just you basically getting out of real estate, essentially. Now, if you want to keep... So those are the tax strategies as well as the legal. Please make sure you're keeping track of these things through using apps such as QuickBooks. Track your income, track your expenses, document everything. Keep your receipts. I take pictures of the receipts, keep them electronically, store them somewhere. That way, if the IRS ever decided to audit you, they couldn't say anything. So hope you guys learned something today. Some things that I talked about today are more on a basics level, and some things are more on the advanced. Like charitable LLC is probably the most advanced tax strategy on the planet. So if you understand charitable LLC, I think you're in pretty good shape when it comes to taxes. So with that being said, thank you guys for tuning in. Hope you guys learned something. This is WGAT 98.3 FM, your voice, your music, your station. My name is Jeff Badu, and I look forward to continuously delivering you all some content. Thank you.
What we the link for street?
Who better bang bang? Bring your way, dear, gonna be your day. Who better bang bang? Bring your way, dear, gonna be your day. You baby break on ya confirm. Say won't pay me, I mean pay wasem. And you will hear my son go at them. Go at them.